thank you for taking the time to attend AMA Academy's FinTech training in partnership with EcoBank. As AMA Academy, we are committed to enhancing the skills of journalists by creating access to experts and to training. We really do understand that journalists are often faced with several beats to cover, and our aim is to help support the quality and effectiveness of reporting through access to training on key topics. More importantly, free access. Just a quick reminder to you all that you must attend all the training modules to stand the chance of winning the top Anglophone and Francophone FinTech Award. Please keep checking your emails for important updates and links to access necessary information from and ahead of all the training sessions. Before we get started with today's session, there are a few things that you just need to keep in mind. Firstly, today's session is recorded. Your mics are currently off, but they will be opened later down the line during the Q&A session. However, in the meantime, and at any point during the training, you are welcome to use the Q&A box. Today's training will be 2 hours long, approximately 1.5 hours of training, and the rest will be for engagements and discussion and questions. Interpretation is available in French. The session and presentation material will be available in English and in French, and it can be accessed via the learning platform. Please remember to complete the task at the end of each module. So far, we have completed 2 modules, including the history of financial services in Africa and blockchain in financial services. Today's module is going to be on FinTech and the transformation of financial services in Africa. I would like to formally welcome our trainer for today, Mr. Wiza Jalakazi, who is an international business development expert, specializing in the setup and the operations of high-performance technology startups across Africa. His career experience spans 13 years and 16 African countries, founding and building tech startups across industry verticals in the business-to-business and business-to-consumer space. Wiza holds an honors degree in information systems technology from the United States International University, and he is currently VP of Global Merchant Business at Chipper Cash, which is a cross-border mobile money service with over 6 million users. He is also a technical partner at Rally Cap Ventures, a global collective combining capital, operating expertise and networks into a collaborative investment community targeting emerging markets. Wiza also serves as the Africa host for This Week in Fintech.com, FinTech Happy Hours, bringing together thousands of FinTech professionals at memorable events in Lagos, Nairobi, Cape Town, and many other cities. Wiza, a very warm welcome to you, and thank you for taking the time to be part of this training. I will now hand over to you.
Thank you so much, Natalie. It's a pleasure to be here and a pleasure to connect with you all. I was hoping that I would be able to see you. I don't know if that's going to be possible, but hopefully it is at some point. My name is Wiza Jalakazi, as Natalie has said, and I'm going to be taking you through this session. with regards to fintech and the transformation of financial services. So if you go to slide 2 in the materials, I want to talk a little bit about what to expect from the session. The first bit is really getting to know each other. I think that helps to set the stage for a productive conversation. I'm going to speak a little bit about myself and my experience, and also give you the opportunity to do the same. If it's not going to be possible for all of us to have the video, then I think we can also use the chat for the introductions. So I'm Wiza, I'm from Malawi, very tiny country in sub-Saharan Africa. I've been in the tech industry for the last 13 years in a variety of roles. Usually my roles are business development, marketing, and operations. And I've been in fintech specifically for the last 6 years. If you're able to, I would love to get to know you better by typing in the chat a little bit about you, where you're from, what you do, and the languages that you speak. Let me do my screen share. Just a moment. Okay, are you able to see this screen?
Yes, all good on my side.
Okay, fantastic. So, okay, I can see some people saying hello in the chats. That's great. Wow, lots of languages in the box, which is fantastic. Elorum from Ghana, welcome. Mamadou. Gemi Sola, I hope I've pronounced that correctly. Elohim, welcome. Jariatu, oh, fantastic, fantastic. Cool. So as the rest of us continue to introduce ourselves in the chat, I think I can get started and kick off, but I really wanted to get to know everyone that I can, so that we can engage more constructively. Amazing. So let's talk a little bit about what fintech is. I know you've had several sessions where you've discussed this with other facilitators at length, but I think because of the varying definitions from experts all over, it's often useful for us to agree on what we are calling fintech for the context of this conversation. So if you look at the history of fintech, I would argue that it starts all the way back with the invention of the first metal money, which was all the way in 1000 BC in China. And coins were made from valuable metals, such as copper and bronze, in order to allow people to conduct trade much more easily. Before the invention of money as we know it today, there was a system of barter trade. And that was obviously inefficient because you had to have the goods and services that you needed in order to be able to trade. When you think about this at scale, you can imagine how many cows it must have taken to be able to buy a house in ancient China. And if you wanted to buy something else with all of those cows, it would just simply never work. So the inconvenience of barter trade led us as humans really to develop the first ever systems of money. And those systems of money started really with coins. And over time, coins evolved, and around the early 13th century is when we started to see different types of coins from different material. And then paper money is also a very old idea. It was first created in China around 800 AD. And around the 15th century, coins stopped being used as much, and we started to see a transition into paper money globally. That has been the status quo really since about the early 1930s, where we start to see a lot of countries have their own paper money, which we're going to call fiat currency for the sake of clarity throughout our conversation. And fiat currency was very interesting because people essentially said that instead of us moving around with all of these heavy coins, let us instead create these pieces of paper that are going to be issued by a central authority. In most cases, that central authority is a bank. And because we trust that the bank is going to maintain the value of these paper currencies, we are going to be able to use them to trade. And that's the fundamental premise of all fiat currency. Now, for a very long time, fiat currencies were typically backed by some other underlying assets. Typically, this would be rare materials such as salt and gold. Up until the early 1970s, the US dollar was previously backed by gold reserves commensurate to the amount of value that is being issued. But after the 70s and the removal of the Bretton Woods gold standard, a lot of fiat currency came to be backed by faith and trust in the governments that issue that currency. And while a lot of global currencies today, they say that their value is backed by the US dollar, today the US dollar is not really backed by anything. The US dollar is essentially backed by faith and trust in the US government and US institutions, such that the value that is preserved in the dollar is going to continue to be so for the foreseeable future. And as of today, in 2022, this is pretty much the state of the world. We have all agreed that paper money that in all of our countries is to some extent typically backed by the US dollar. We have all agreed that this paper money has value. And instead of us moving around all these rare resources and all of these physical assets, we can instead exchange this paper money, this fiat currency, in order for us to conduct trade at a global level. And I think this is important to highlight because it will start to become clearer as we start to unpack the differences between electronic money and digital cryptocurrencies. And having this background understanding will be necessary for you to see some of those differences more tangibly. So the simplest definition of fintech, which I enjoy, is the one that I'm sharing on the slide. Simply put, fintech is just technology that is used to improve the delivery of financial services. And if you look at all of the historical elements that we've discussed, including coins, barter trade, etc., all of those are fintech to some extent. It's just that the way that we view fintech now is the combination of the historical existence of financial services, that coming together to meet the internet for the very first time. The internet has been a real game changer for fintech. And because it is a relatively recent invention, a lot of fintech innovation that we see has been in recent years. So it's only now in the 21st century that we're starting to see the term fintech used a lot. And I think we are at the infancy of the industry for the information age. Because when you think about it, right now, all of us are sitting in different parts of the world. We're all able to see and hear each other in real time without moving from our physical location. So many different types of information move at the speed of the internet, which is in real time, it's instant, and it's globally available. But today, money doesn't move at the speed of the internet, except for cryptocurrency, which is something that I think we can discuss. So I think it just goes to show that despite all of the innovation that has taken place over time, there is still a massive opportunity for financial services companies and entrepreneurs to build tools and systems that can enable the next billion people to be able to access financial services. Most of them would be accessing financial services for the first time. So this definition is the one that we're going to carry for our conversation going forward. I would love to encourage anyone who is interested, if they have any additional thoughts, questions, comments, please put them in the chat or request to speak. It's always a lot better when we have a conversation rather than me speaking into the void and then trying to handle everything at the end. So please do feel free to do that in both English and French. You're not interrupting. We can have the conversation as we go along. So in order for fintechs to exist as we know them today, they don't exist in a vacuum. There are several factors or environments which affect the existence of fintechs today. And I'm going to take a bit of time to walk through all of them. The first one, and in my mind, the most important one, is around regulation. Regulation is necessary because imagine a world in which anyone today could wake up and start issuing their own money in your country and start encouraging other people to start using that money instead of the country's local currency in order to transact. It would lead to chaos and indifference. People would not be able to measure value accurately. There would be different systems of accounting for different types of monies, and it would be impossible for an integrated financial world. Today, it's possible for me to be sitting here in Johannesburg and receive money from somebody in Brazil because we've all agreed as a world that there are going to be certain standards that we choose to adopt with regards to money and financial services. And all of these standards at a global level are set and agreed, refined by financial services regulators. In many of our countries, the apex regulator is typically the central bank. So where I'm from, in Malawi, our central bank is called the Reserve Bank of Malawi. I'm fairly certain that a central bank exists for each and every one of the countries that all of you are from. And these regulators work hand in hand with each other internationally and also with other regulators in each country to define regulations that govern how financial services come to be. So if you look at, for example, the history of, let's say, M-Pesa, which is a mobile money service in Kenya, that by now I will expect many of you are familiar with. M-Pesa came to be in Kenya in the early 2000s in the absence of a clear regulatory framework. So Safaricom, who are the mobile network operator that owns and operates M-Pesa, they had an idea for a concept to be able to send money electronically through text messages. And at the time, the regulation in Kenya from the central bank did not have any provision for anyone who was not a bank to be able to hold value, hold money electronically. So they then went into partnership with a bank, which is NCBA Bank, one of the larger Kenyan commercial banks, and said, okay, NCBA, since we don't have a framework to be able to issue or hold electronic money, why can't you be our sponsoring bank to enable us to have all of the money which sits in people's M-Pesa wallets to be sitting instead in a bank account in full, an omnibus bank account where all of the funds are held with your bank, such that when the regulator comes to us and says, hey, you're saying that Visa has got a balance of 2,000 shillings in his mobile money wallet, where is that money today? If I want to seize it, how can I seize it? And as a result, that model that M-Pesa and NCBA pioneered for holding electronic value, that has become a template that many other African countries have adopted to develop electronic money issuance regulations. So you see, electronic money is really the underlying infrastructure layer that enables a lot of the fintech innovation that we see today on the continent. So when you think about mobile money, when you think about digital wallets, when you think about mobile banking, all of those are different forms of electronic money. And banks typically have always had the capability to take cash deposits and issue you an electronic balance, which is what you then see on your bank account or when you go to the ATM. That infrastructure has been around for a very long time. And up until the early 90s, it was typically impossible for anyone globally to think about doing financial services without being a bank. It was only the banks and the corresponding card networks, such as Visa and MasterCard, that had an effective monopoly on digital finance as we know it today. And I think that has been great for some reasons. As a result, for example, now you can have a Visa card issued by whatever bank, and you take that and you're able to spend at pretty much anywhere in the world. You can take your MasterCard, go to an ATM in a country somewhere 15 hours away, and be able to withdraw currency, local currency, using your MasterCard. And that sort of monopolistic environment is what has enabled those industries to grow because there were no other alternatives. But now come the early 2000s, in Africa specifically, we had a very, very large growth of mobile network operators. If you look at the biggest companies in your country now, the biggest publicly traded ones, it's typically mining or manufacturing, banks, and telecoms. Those are the three categories that typically make up the largest public companies in most African countries. So now, as the telcos started to see the opportunity for distribution, because they already had SIM cards, people who have phone have already got a SIM card. I can, as a telco, I can remotely update a SIM card to add new functionality. So we sort of started to see at the time things like ringtones, value-added services. Around those times when the telco industry started to think through, okay, we're already delivering many of these services via mobile phones. Why can't we try to deliver financial services? And really, I would say M-Pesa pioneered that space in the continent. And a lot of what we see today in terms of regulation around mobile financial services, which are really the key avenue for digital finance in Africa. When you think digital finance, maybe in the US or Europe, you might imagine somebody going to a computer and logging onto a website. But in Africa, digital finance is mobile finance, and thus mobile financial services are really the key underlying layer that powers that space. So taking it back to the issue of regulation, a lot of businesses, telecom businesses and non-bank financial service players, they saw the opportunity that took place with M-Pesa specifically in Kenya. And they sought to replicate similar models in their respective markets. Because, again, the regulation did not exist, the telecom industry has had to partner with banks in pretty much all of the African countries in order to be able to issue financial services in those markets today. And thus, without regulation, there is no fintech industry in Africa, because at the end of the day, all of the various financial services that you see, mobile and non-mobile, bank and non-bank, in every African country, that money is sitting in a bank at the end of the day. And I think this is a very important thing to understand and underscore as we start to unpack some of the challenges that exist in the space and some of the ways in which some fintechs have been able to grow rapidly in a very short period of time. So that's one layer that makes up a big part of the fintech puzzle. The second layer is on the technology infrastructure. So what you find is that many fintechs are not really that innovative. What fintechs are good at is being able to build new, novel experiences for specific audiences. So for example, with M-Pesa, they knew how to build an experience that worked for the SIM card offline for their customers that was simple and easy to use. And when you look at it from that perspective, the level of innovation that they have applied is really on the technology layer. They've taken everything that banks offer, as an example, packaged it differently, given people a new way to access that service in a way that doesn't involve them, going to a physical branch, set up a network of agents that allow people to convert money from cash to electronic money at their convenience, and then incentivized people to start to use the service by advertising for those who are sending money back home. So when you think about the innovation that has taken place, they didn't really invent anything new, but then they combined different pieces of infrastructure, right? Hardware, software, systems, capital, and ideas, as well as support structures such as people in the agent networks, to be able to create a new way for people to engage with a financial service. And all of the fintech innovation that we see is some version of this type of combination. You take these different pieces, put them together, and create a new experience, which is attractive to a new type of audience. But at the end of the day, the underlying infrastructure is still the same. It still sits in a bank somewhere, and settlement still has to take place through traditional banking rails. And that's important to note because it becomes difficult to build different types of business models when at the end of the day, you still have to perform the bank-related tasks in this way. That being said, there have been fintechs that have been able to deploy their infrastructure in ways that have been able to create entirely new types of business models. So for example, if you take a look at a fintech called Branch that operates in Kenya and Nigeria, they're able to offer you loans on demand on your phone by providing a credit assessment based on your transaction history and your contacts. So while previously a bank might have had to wait to assess you, get letters of reference, for example, get letters of guarantee from your employer, a fintech like Branch is able to address a much wider market because they are using that underlying technology in order to do their underwriting. What's interesting about branch is that at the end of the day, the loan still has to be issued by a bank. So in Nigeria and in Kenya, branch started by working with bank partners for issuing loans where they do the underwriting, but then the bank at the end of the day is the one that actually issues the loan. And the model has been so successful that branch now owns its own banks in both Kenya and Nigeria. The most recent one was an acquisition of a Kenyan bank, but they've had a microfinance bank in Nigeria for a number of years. So you start to see that even if you're innovative as a fintech, you still need banks in the picture because the banks are the only ones who can meet the regulatory requirements at a scale which is satisfactory to the regulator. So again, you start to see that there's a very clear connection between all of these layers, with regulation being at the bottom, setting the rules for what financial services players can do and cannot do. And then you now see fintechs coming in at the technical, you see banks coming in at the second layer who consume those rules and offer services to consumers. And then you now see fintechs coming in at the technology layer above the banks who are above the regulation to extend the capabilities, the reach, the functionality of banking services. And at each of these layers, additional value is being created. And I think we're going to see some other layers come up in time as the fintech industry evolves. So that covers on the regulation and technology structures. But again, these pieces alone are not enough for fintech to exist. You also need support structures. And these are the non-technical elements, including people, that help to make fintech happen today. So for example, if you go to a service like WorldRemit, let's use WorldRemit as an example. WorldRemit is a UK-based remittance service that allows users to link their bank card and then send money to various destinations in the world. And that money can be credited typically to a mobile money account, to a bank account, or some other form of electronic value. WorldRemit is extremely popular. They're a multi-billion-dollar company, and they have been successful because the service that they offer allows the convenience of instant settlement. So if you go to the WorldRemit website today and you add your bank card and you want to send money to Malawi, you can do that transaction within 5 to 10 minutes. And within 5 to 10 minutes, your recipient in Malawi, say you're in the UK, for example, your recipient in Malawi will receive the money in Malawi Kwacha instantly. But what is actually happening is that that money is not moving anywhere at all in real time. Because again, the regulation globally is such that there is no avenue for people to move money around cross-border. The regulation doesn't support those sort of use cases instantly. What exists is for interbank transfers internationally, which is typically via the SWIFT network. So if you've ever sent money from one bank account to another across borders, that is typically powered by SWIFT, which is it's a society. Let me just pull the definition here. Society for Worldwide Interbank Financial Telecommunication. This layer, SWIFT, is really the only cross-border financial services infrastructure that exists today, which is governed and accepted by central banks all over the world. So at a bank level, that's pretty much where the fintech technology layer ends on the banking level. What happens in practice when you initiate a transaction on a service like WorldRemit, to transfer funds from the UK to Malawi is that WorldRemit actually already has money sitting somewhere in Malawi, such that when you initiate that transaction, they take that money from their pre-funded float, settle the customer that you're sending to, and then at a later stage is when they will do the SWIFT transactions to make sure that they settle all of the value that they have actually transferred at scale. And all of the innovative fintech and mobile money that you see, all of these employ some version of that model where you have different pots of money sitting in different locations so that you can give people the illusion of instant transactions. That's the same way that Visa cards and MasterCards work. They have lines of credit with various banks, but when you take your Visa card and you pay at a point of sale for your groceries, that money doesn't leave your bank account immediately. You'll see your balance reduce, the funds will no longer be available, but there's a very long mechanism that has to take place involving very many people to actually get that value settled from your bank account to the bank account of the merchant that you're paying. And as a result, because of the regulation is fixed and firm, and regulation takes time to evolve, financial services companies have had to fill in the gap by pre-funding liquidity, having money in different pots in all over the world so that you can give people the illusion of instant transactions. And in the background, you have a lot of people manually processing transactions over networks like SWIFT to settle the funds at the end of the day. So a lot of people who learn this for the first time, they become surprised because in the age of the internet, where we can move money around so quickly, why is it that we can't move, where we can move information around so quickly? Why is that we can't actually move money around? The best we can do is to give the illusion. But for you as a customer, the illusion is fine because at the end of the day, you still get the outcome that you're looking for, which is that you either get the cash that you're withdrawing or you're able to process the transaction that you're paying for. But in the background, because of all of these different steps, fintechs have to be very innovative and progressive with the business models that they develop to be able to make any money at all. And we'll unpack that a little bit later in the next section. So the next section is around treasury and settlements. I've started to speak about it with the illusion of instant transfers. But just to unpack it further, I think pretty much all of the fintechs that you see, because of this requirement to have different pots of money in different locations, they all have large teams that work on the treasury function, which is making sure that you have enough money where you need it in order to provide the service that you're advertising. So for example, if we today decide that we're going to open a credit business in Cote d'Ivoire, and we're going to be offering loans to Ivorians, we need to make sure that we have enough CFA francs in our bank accounts in Cote d'Ivoire at any one given time to be able to issue those loans. It becomes a bit more complex when you're now doing that in more than one country. So let's say we now have, EcoBank has generously decided to give us $1 million to start doing loans in all of these different countries. The $1 million will be sitting in our EcoBank bank account in Lome, but we now have operations in Cote d'Ivoire. And because our friend Cecilia from Zambia has invited us, she now says, come and set up the loan business in Zambia. We now have to manage a float of $1 million in Lome, in our EcoBank account. Then we also have to manage a CFA franc account in Ivory Coast. And then we also have to manage a Zambian Kwacha account in Lusaka. So when you start to see the scale at which you're operating, the layers of complexity start to increase with every additional currency that you add. So say, for example, tomorrow we get a lot of demand for loans in Zambia, but all of our money is sitting in Lome. we can't move it quickly enough to be able to serve those Zambian customers, and thus we miss the opportunity. So to do this, in order to operate in this way, what most fintechs do is that they divide the capital that they have to pre-fund liquidity in all of their different locations. So what that would look like is to say, maybe we take 200,000, we put it in Abidjan, we take another 200,000, we put it in Zambia, and then we monitor the flows. When we start to see that Zambia, people are taking more loans, and remember, those loans are going out in Zambian kwacha, so they are repaying back in Zambian kwacha. But we need to be able to fund liquidity in Ivory Coast. It's not going to be easy for us to take our Zambian kwacha in Zambia and find somebody who's in Ivory Coast who's going to be willing to buy it as Zambian kwacha. So what ends up happening is that that currency must be converted back again to the US dollar. And remember at the beginning, I said the US dollar is perceived to be the world's reserve currency because people have trust in it. So this complexity exists for all fintechs. And as a result, you start to see the need for dedicated treasury and settlement functions, just so that you can ensure that you have money in the places that you need it at the times that you do. However, every time you move money, that typically incurs a cost. So for example, if you are to do a SWIFT transaction from one bank to another, the bank that is sending will charge you for sending that money. And then also the bank that is receiving may charge you for receiving that money. So in the world of fintech, it's actually very counterintuitive, but the less money you move around, the more money you're able to make, because moving money is a cost center for you. Even though you exist to give the illusion of money moving around instantly in a way that isn't possible for the money itself with the regulation today. So I'm going to pause there and just quickly recap. We have regulation as a pillar, the main pillar which underscores all of fintech today. It's the main thing that creates an enabling environment for both banks, fintechs, and other non-bank financial institutions to exist. You have the technology infrastructure, which in the context of Africa, telcos specifically have been able to leverage that very well to get the distribution that banks don't have. And as a result, you see that there's the success of very many mobile money services. M-Pesa was the first one, but now we have Orange Money. We also have MTN Momo. We also have Airtel Money. That are the big four mobile financial services that exist on the continent today. Between them, across all of the different countries that they operate, I think they serve close to 200 million users of mobile money in Africa today. So it's a very, very big industry that is still very new. You know, just 30 years ago, there was no financial services industry like this. I like the question that Alorm has asked. To what extent has the various regulations helped to deepen financial inclusion? I think you may mean to deepen financial inclusion. I'll take that one shortly. But certainly, yeah, without the regulations that exist on the continent today, there really would be no industry. When you look at, for example, some other markets like the United States or Europe, or let's take the United States specifically, you can't build a telco-based mobile money service the way that it works in Africa, in the US. Because in the US, the regulation is such that only the Federal Reserve issues value, electronic value, and they can extend that capability to banks. But at the end of the day, you as a telecom player or as a fintech startup, you can't say you have a wallet that's holding US dollars that are not, at the end of the day, held either in part or in full with the Federal Reserve. So you find that certain things like when you do a bank transfer in the United States, it goes over infrastructure known as ACH, that's automatic clearinghouse. And it actually takes a day or two for the funds to reflect from one bank account to another bank account. Meanwhile, if you go to a country like Nigeria and you want to do a bank transfer, you end up using a system called the NIBS, which is the Nigerian Interbank Settlement System. And that transaction will move from your bank account to another bank instantly in real time, 24 hours a day, 7 days a week. And that service is possible because the Central Bank of Nigeria instructed the NIBS, the banks, to build a real-time inter-settlement system. So I'll certainly say in Africa, the regulation is not quite the best in the world. I think there are some other jurisdictions like in Southeast Asia, Singapore, where you see really, really progressive regulation, but it's definitely amongst the best in the world. I always get surprised when I'm doing business with people in the US and they're trying to pay me, and it takes so long for the money to settle, where in all the countries I've lived in, Malawi, Nigeria, Kenya, we all have real-time interbank payments. And in Nigeria, it's actually the default option. So in Nigeria, if you're transferring from one account to the other, there's no option for you to do that transfer so that it will reflect the next day. So you can't lie and say I've transferred, but it hasn't settled, which I think is very amazing and goes to illustrate the extent to which financial services regulation in Africa is actually leading the way for us globally.
Wiza, if I can stop right there, because we do have a question in the Q&A chat.
Okay.
It is in French. It's from Basiru. So I hope I will get the translation correct. If not, Eric will correct me. The question is, how do you think this regulation you are talking about could be made? So on what criteria should we base ourselves to make the regulation?
Yeah, that's a great question. I think there are always multiple elements to consider. Now, the big one is obviously about access. A lot of Africans today are excluded from the global economy because they can't participate without access. So for many African countries, remember, Africa is still very young as a concept. A lot of our countries, all of us probably got our independence around the 1960s. So the idea of African republics is still very new. And we are in a world where we have economies that have got participants that have had institutions for hundreds of years. When you look at Europe, they've had their institutions for hundreds of years. Very few African countries can claim to have had real institutions for over 60 years. So you have a very young government infrastructure in general, and you have a lot of people, a lot of young people who need to be able to interact with the global economy, but they can't do that if they don't have any financial service at all. And today, depending on where you source your estimates, as many as 55% of people on the continent don't have access yet to formal financial services. In some countries, it's very high. In some countries, it's very low. And what governments are prioritizing now is just enabling that level of access. So what that looks like from a regulatory perspective is to perhaps lower the barriers to entry for financial service providers. And you see this a lot in countries like Tanzania, in countries like Ghana, where the process of getting up and running in financial services is clearly defined, and the government puts incentives for you to set up in those markets and get started. Now, another big I got disconnected for a second. I don't know why. Okay. Another big angle to consider is on the angle of protecting the consumer. So yes, it's very good and very necessary to enable access, but we also need to be able to project the consumer when they use the financial services. So what happens to me if I take my money and I deposit in a new financial service, and all of a sudden that financial service disappears, or I want to withdraw my cash, but I can't get cash from that financial service? They're giving me excuses. They're not telling me where my money is. So another very big element is around the consumer protection. Yes, we want to grow access so that our people can be able to participate in the global economy, but we also need to keep them safe, because people all over the world see the opportunity that Africa is. We're going to be the youngest continent in the next 15 years by far, and have the largest active workforce that is still young. So people see that opportunity, and not everyone is well-intentioned. So the government needs to make sure that there are adequate protections in place such that people are not harmed unnecessarily as they start to use financial services, especially with digital financial services. A lot of people in Africa, we still trust cash. I'll tell you that according to data from Network International from last year, so Network International, they provide a lot of the point of sale devices that you see in many African countries. They're one of the largest suppliers. Their research indicates that over 93% of retail transactions in Africa today, they take place with cash. And while cash has been working for hundreds of years, in the internet age, in the information age, cash is unnecessary. And when you go to some parts of the Western world, you will barely ever see cash. But here in Africa, cash remains king, but it has certain inconveniences. It makes it very difficult for the government to track people's spending so they can make informed decisions about how best to tax people. I feel like personally, a lot of African countries were overtaxed because the government doesn't know how much money actually moves through the system. It's also very unsafe for people to carry. Here where I live in South Africa, the crime rate is extremely high, and you start to see a lot of robberies take place. And oftentimes the target that they're going for is cash because it's easy to move around, but it's unsafe for me to use as a consumer. So I think those pillars are the two ones that I would expect many African governments consider most when thinking through regulation. I think a third one will definitely be around, if we have an electronic money system, how does it interconnect with other payment systems in Africa and beyond? And I'm very excited by the launch of the Pan-African Payment and Settlement System called PAPS, P-A-P-P-S. It's a new system which is going to allow African banks and other financial institutions to be able to do transfers to each other in close to real time, which is much, much faster and much, much cheaper than SWIFT, and doesn't rely on US dollars as an intermediary currency to facilitate that exchange. It doesn't make sense to me why I, as a Malawian today, if I want to go to Rwanda tomorrow, I need to change my Malawi kwacha into US dollars so I can exchange it for Rwandan francs in Rwanda. When there's very likely some people in Rwanda who might be traveling to Malawi and might want Malawi kwacha. But the systems and the regulations that enable the matchmaking between demand for African currency pairs, it doesn't exist yet, but I think we're slowly getting there. Natalie, are there any other questions on this topic before I proceed?
There is one question in terms of how do we achieve this cash light system?
I think it starts with initiatives like this. You know, it's not easy. We at Chipper Cash have 6 million users. How many people are there in Africa today? Over 1 billion. So each and every player has got their role to play, even yourselves as journalists. By enabling yourselves with this knowledge, you're able to tell better stories with regards to what is happening and the possibilities within the space. And that does help a lot. It contributes significantly to the growth of the industry, because with better stories, we get better access to capital. And access to capital is needed because we need to invest to build the infrastructure from scratch. In some other countries, like in Europe, fintech is useful, but I don't know if it's as useful as the way it is here. In Europe, somebody can get access to a fintech app, and it might just increase the convenience of some things that they're doing with their bank. But here in Africa, fintech can literally change lives. When you think of farmers who get access to credit for the first time through mobile money, you think of small shop owners who get access to financing for their stock, the stock that they keep in the shop for the first time. It's really enabling for the first time a generation of free Africans, Africans in republics, to start to build generational wealth. And I think all of us have a role to play. And the faster we're able to achieve this cash-light society, the more financial opportunity that we can create for Africans at scale. So now moving on to the main meat of the topic. I know I've spent a lot of time to give you the context, but I think with that context, moving through the next slides is going to be very easy and very clear, because we all understand where we are coming from, what the challenges are, and where we are going. Maybe before I start, I see 2 more open questions. It would be useful to just tackle those quickly, if you may permit me, Natalie.
Sure thing. Just give me 1 moment.
I think the question from Komi, I'm using Google Translate. Do you really think the future lies in the use of fintech on the continent to revive financial services? I definitely think so. Banks alone have not been able to do it. So banks in Africa, when you look at their performance, their financial performance versus banks globally, African banks are amongst the most profitable businesses that you can get into in banking in the world. And they've been able to grow very quickly, and they have a very big reach. I think EcoBank now is in 32 or 33 countries. But even still, banks alone are not able to service everybody. Even on top of that, you have the telcos. Telcos have been able to grow 200 million plus user base across Africa. But both banks and telcos alone are not able to service everybody. So there's still quite a lot of room to grow. And certainly, I think that we have a good chance, if we rely on fintech, to be able to build the financial services future that we want. The other question from Bonaventure, I'm not able to translate it. I'll wait for Natalie or Phil to advise on that. Then I'll take the last 2 from Google. Does the existence of cash-based system create a lopsided outlook for the future? No, I don't think so. I think cash still works. It's very effective. You can move it around quickly, you can settle, people trust it. I think what's going to happen is that cash and digital finance are going to coexist for some time. And then eventually we might see some cash start to disappear. And the last question from Eve, let me just translate it. I like this question so much, Eve. So Eve is asking, with all this experience as acquired, could you give us some advice for those who, at the end of the training, would like to embark on the transformation of financial services by creating a fintech company? I think at a high level, what is very important is to know that it's a long game. It requires a lot of patience to get started. To get the permission from the regulators, even when you partner with the bank, it can take up to a year, sometimes 2 years. So have the patience. Partner with professionals, people in the banking space who have got the relevant experience to get you up and running. And then 3, where you're going to really have a strong advantage as journalists is in your ability to tell stories. Apart from banks and telcos, a lot of the fintech industry in Africa is funded by venture capital. So venture capitalists will invest money upfront in your business for an equity stake to give you the chance to build it so that they can participate in your success if you win. And if you lose, it's fine. Their business model, it caters for a provision for those types of losses. And what I've learned about fundraising, in my career, I've been at businesses now that have raised cumulatively over $350 million. At Chipper Cash, we raised $150 million in November last year. And yes, we have a good product. Yes, we have users. Yes, we are creating impact. But it's not the reason why the investors gave us the money. The reason why the investors gave us the money is because of the story that we told them. So I can't emphasize this enough. Your ability to tell stories, if you want to get into the fintech industry, that one is an absolute superpower. I'll take the rest of the questions as we proceed because of time, and I just want to cover a few more of these slides. So please allow me to do that, and then I'll get back to the questions. So this is where we are with the state of the fintech industry in Africa today. Like I said, this is now even a more recent report that I'm citing here in this slide. It was released by McKinsey about 6 weeks ago. So it's extremely current. Again, 10% of transactions. Network International's data was saying 93% of retail transactions are cash. This McKinsey data is for all transactions, including non-retail transactions. 10% of transactions in Africa are digital. So there's still a lot of room to grow to be doing the digital financial services. And mobile has shown itself to be the best distribution layer. If you look at the revenues that fintech companies are generating, you see $46 billion. It's not a small amount. So it's possible to build impactful businesses that make money while serving large populations at scale. And when you look at some of the larger players like Orange, MTN Money, I think their group revenues for financial services every year are typically in excess of $500 million. So they invest a lot upfront. It takes a lot upfront to get started. MTN Mobile Money in Ghana didn't make money for the first 7 years. Then in Uganda, they didn't make money for the first 6 years. But now they're able to reach extremely high volumes because of the scale that they have, serving millions of customers who are transacting every day. Then they're able to grow and build these very profitable businesses that are enduring, that are employing hundreds of people directly, employing thousands of people indirectly through their agent networks. And it's very easy to quantify the impact that the fintechs create. At the same time, they also make certain services much, much more affordable. Apart from the physical cost of, for example, physically taking myself from where I am in Johannesburg to a bank branch to go and apply for a loan, which I may not get, the bank also has got the cost of assessing me, assessing my credit, trying to figure out, can we lend money to this person or not? Whereas fintechs, they go to the banks and say, okay, you guys, you have the money, you have the permission from the regulator to lend. Why don't we introduce a cheaper way for you to access more customers, reduce your costs of assessing credit, and then we both make money. And the bank is happy because they're able to get more of their deposits out through loans. The customer is happy because they're able to access the financial service much, much faster without having to physically leave their physical location. And then the telco is happy because they charge on both sides, so they're able to make money as well. So it's one of the few market creating innovations, really, financial services in Africa, where a lot of value is being created, friction is being reduced, and costs are being removed at the same time because of the introduction of an industry. So as a result, you see a lot of capital is excited about the opportunity that exists on the continent. That being said, there are challenges. And I think the 4 key ones as described here are reaching scale and profitability. Before you reach profitability, you certainly have to be at scale. That's why you see, like with MTN in Ghana, they invested for 7 years before they were able to get to the scale where they have enough customers that they're making enough money from the individual transactions of those customers to be able to service all of their costs. So it's a very capital intensive business, and banks, telcos, fintechs invest typically millions of dollars upfront in a market to get up and running. I would like to cite a case study of Wave Money. Wave Mobile Money currently operates in Senegal. So those in Dakar, I'm sure, are familiar with it. They came to compete with the telcos directly. And they've had to invest in excess of $20, $30 million upfront to be able to build their service. And today, as I understand it, they're the #1 mobile money player for smartphone users in Senegal, because they have been able to undercut the telcos on their models, the business models, so much that the telcos even had to change their prices. And that's only possible when you have patient capital that can wait for you to get to the scale to be able to do what you want. So sometimes I read in the paper that, X fintech company has raised a very large amount of money, and it's not clear to the reader why somebody would need so much money to be able to start a fintech business. And I hope having that context on the regulatory side and how things work can help you to have a more refined picture of all of the costs that are associated with getting up and running, and all the time that it takes for you to reach the number of users that you need to reach in order for you to be profitable. Another big challenge is an uncertain regulatory environment. In some markets, like Nigeria, for example, the regulator can make sudden changes to the space that greatly affect all of the players that are operating. An example of this is when the Central Bank of Nigeria restricted the use of BVNs to banks only. So to give you some context, in Nigeria, when you want to open a bank account, the first ever bank that you open a bank account with, they issue you with a BVN number. So BVN stands for Bank Verification Number. And it's an 11-digit number, which is tied to your phone number and also your ID. And the central bank basically keeps a database of your identity information tied to that BVN number. So the next time that you need to open a bank account, even with a different bank or another financial service provider, you don't need to go there. You don't need to do anything. All you need is your BVN and your phone. And when you submit your BVN and your phone number to the new bank or financial service player, the central bank transfers your identity information to that new player. And then they say, here's Wiza's information. It's fine. You can open an account for him or her. So it's really an amazing progressive technology that doesn't exist in many other African countries. And for a very long time, fintechs in Nigeria were allowed to use BVNs to create accounts for their customers. But because some of the fintechs did not have the mature anti-money laundering compliance frameworks that the banks have, the system ended up being abused. The system ended up being used for people opening fake accounts, for terrorism financing, for money laundering. And as a result, the central bank had to respond and say, no more BVN for fintech. You have to only onboard manually, get the identity documents, and manually verify. And that disrupted business for a lot of fintechs in Nigeria. Now, thankfully, the central bank has got some guidelines for how fintechs can apply to get access to the BVN system back. And it has now sort of reduced the impact of that change. But you can see that if they had kept that policy, a lot of fintech businesses in Nigeria could have died completely. So that sensitivity to regulatory changes is something which is a big challenge, especially because as a fintech, you might not have the capital to be able to endure such a change if it happens. I think that also speaks to the other point of building robust corporate governance. A lot of the fintechs, again, in the race to be #1, in the race to go quickly, they don't pay too much attention to their corporate governance, compliance. How do we ensure we are in good standing with the laws and the regulations that the Reserve Bank has set? And you see that fintechs, because they're technology experts, when they start, they hire a lot of technology people. You start engineers, you get designers, you get customer support, but then maybe you don't think about all of the compliance, anti-money laundering and fraud monitoring people that you also need to employ until something bad happens and the regulator tells you, we need to shut you down. Only then is when many fintechs start to think about, okay, how do I conform to the regulation? And that challenge exists because you have the convergence of two different worlds. The technology side, which is software engineers, designers, programmers, etc. And then the finance side, which is bankers, compliance professionals, and support people. So I think it's natural and expected, but the smart fintechs, they think about compliance first. And as they are launching, they already have the engagement with the regulator, and that helps to mitigate the challenge that is associated with this. So when you talk about the African fintech landscape and how it's growing, yes, we present Africa as one continent, but from a financial services perspective, it's actually very, very highly fragmented. You have traditional banking countries like South Africa, where I am. Basically, there's no one who I know who uses mobile money in South Africa. I contrast that to Kenya, where there's mobile money specialists. And there's basically nobody I know in Kenya who doesn't use mobile money, as an example. I remember I had a housekeeper in Kenya who was helping me for 2 years. And I told her, Sheila, please open a bank account so I can pay you. And she refused. For 2 years straight, I paid her only on M-Pesa. She's like, why do I need a bank account? I said, okay, fine. It's very interesting. Then you have disrupted markets like Nigeria and Egypt, where you have the bank infrastructure, but at the same time, you also have some regulation that allows non-bank financial institutions to build bank-like services on top of banking rails. And that's why you have all of these sophisticated interpayment systems, BVN, all of those great innovations are coming from Nigeria as a result of their market. It's important to note that Nigeria specifically has been very opposed to telco-led mobile money. So if you Google around, you'll see that MTN, Airtel, they've been applying for years to get a license from the Central Bank of Nigeria. And only last year did both Airtel and MTN get a payment systems bank license, which is not really what you need in order to build the type of mobile money services that they build in other countries. And then you have crossroads markets like Cote d'Ivoire, Cameroon, Senegal, where the payment infrastructure is not fully mature, but there's enough regulatory room for you to play. And I think the most relevant example from that region is Wave Money. They didn't exist 10 years ago. They came all of a sudden, they've been able to grow very quickly. And now they're a very big threat to some of the telco operations in those markets. And again, global investors have seen the opportunity. So I think Wave raised $200 million in their last round of financing. And they have some very big investors who are also participating, such as IFC, who are giving them credit for their product development. And you see that obviously IFC has a goal to want to improve infrastructure in Africa and reduce costs for many people. So definitely you see that these crossroads markets, I think they're the ones that are most ripe for fintech to be able to grow very, very quickly. Speaking further to just the fragmentation of the regulatory landscape, you find that different digital types, digital financial services are regulated differently. So for example, Nigeria, South Africa, Kenya, Ghana, those countries have got a regulatory sandbox such that if you have a new type of idea for a financial service, like when the time that M-Pesa was starting in Kenya and there was no regulation, if that time a regulatory sandbox existed, they could have gone to the regulator and said, okay, we are the AMA Academy in collaboration with EcoBank. We're launching a new product. We don't see anything in the laws and the regulations of the country that speaks to our product. So this is what we want to do. And you tell us, can we do it? Yes or no? Oftentimes what happens is that the central bank will say, okay, you can do this, do it for 6 months, you monitor, but have these limits in place, have these controls in place. If at the end of 6 months, everything is fine, then we can give you permission for maybe 1 year. And then after that 1 year, if everything is okay, then we can issue you with formal permission to expand it wherever you want. And then we can use those learnings to develop the regulation for how future players like yourselves should try to come in. And I think this is really, really great. It allows fintech players to start to innovate, and it enables them to do so in a manner that reduces the risk of the regulator coming to say, oh no, shut that down. after you've already built something and you've got paying customers. Similarly, in those markets, you have tiered licensing, except for South Africa. So for example, you can be in Nigeria, you can be a microfinance bank. And that means that you can allow your customers to do transfers, but only up to 1 million naira per transfer. And it's not the highest, but it allows fintechs to get started such that when they grow, they can then acquire different types of licenses. Whereas in a market like South Africa, there's no tiered licensing for banks. If you're a bank, you're a bank. And if you're not a bank, you're not a bank. So what ends up happening is that all the fintechs in South Africa are forced to work with the bank much more closely than they might in other markets. The alternative is to get your own banking license. And that is an extremely cumbersome endeavor, which would take far more energy and time than your initial fintech idea was setting out to do. Then you have the financing side. This one is still a little bit immature in many markets, but basically, is it okay for you to take money from groups of people like crowdfunding? So let's say today, Google, who is one of the participants in this call, they want to start a business that is going to be selling some products at scale. Can I collect money from all of the rest of us here so that we can loan it to Google? In many African countries, the regulation for that is still a little bit unclear. I think definitely Kenya is working on something, Egypt is working on something, but you see this happening a lot in informal communities. So we have these village savings and loans associations. In Kenya, they're called chamas. In South Africa, they're called stokvels. But it's groups of people that come together to loan each other money. And I'm very sure they exist in your country as well. So the regulation for those is still being developed. And with time, I think we'll start to see exciting products that take advantage of that need in this space. And then you have the controversial one, which is cryptocurrency. Cryptocurrency is very big in Africa. According to Chainalysis, who are probably the leading blockchain analytics firm, over $100 billion of value was transacted across cryptocurrencies in Africa in the year 2021. And a lot of this value is large businesses who are moving large sums out of countries like South Africa and Nigeria that have got challenging exchange control regimes. So people end up converting their money into a cryptocurrency asset because cryptocurrency is not considered as money in that country, and then they're able to move it out. For me, that seems to suggest that there's a lot of demand for cross-border business within Africa, and the current financial system is not able to serve it. Because if those customers were satisfied with the services that they're able to get from fintechs today, they probably would not have a need to get into cryptocurrencies. Of course, there is a small segment of users who use the cryptocurrencies for investment purposes, so speculative bets on whether the value will go up and down, but this don't make up the vast majority of users for cryptocurrency in Africa. So it'll be interesting to see how the regulation for that evolves. So far today, the only country that has got formal regulation for cryptocurrency is Mauritius. So they have a Virtual Asset Service Provider Act. And we also see some other countries like Burkina Faso who are on their way to developing some sort of regulatory framework for the same. And then finally, we have a very controversial one, which is open banking. My view on open banking is that the banks are not very excited about it. This is basically whereby you take your credentials, such as your username and password for your bank accounts, but you enter it onto a third-party service. And then that third-party service is able to automate some transactions on your behalf from your bank using your bank account credentials as if they were you. It raises some very interesting questions around security. So for example, if we work with a third party and that third party is compromised, do I now go back to my bank and say, oh, my money was stolen, you should refund me, when I voluntarily gave them my username and password? Those are some of the real challenges that are existing with the open banking industry. And I think those challenges exist globally. So we're going to see how the regulatory landscape evolves over time. But certainly these are the main considerations that startups and fintechs look at as they are making decisions on where do we go next? Where do we get started? So it's important to note that fragmentation is very different from Europe, where you have common regulation. You get a license in one market, you can do everything in euros for all of the Eurozone countries. Nothing like that exists for Africa. It's very fragmented, and you also have to build from scratch in all of the different markets that you operate in. As a result, the operational structure of fintechs looks very different. If you go to Chipper Cash office in Nigeria, it's very different from the Chipper Cash office in Uganda, because you need different people to do different roles in order for you to fulfill the local regulatory requirement. So I think there are some key trends which are helping to accelerate the growth of fintech. I've spoken to some of them already, the push for financial inclusion. I talked about that at length, so I'll not talk about it now. Dethroning cash, another one I talked about. I think it's quite clear that there's a big opportunity to move away from cash, and cash is expensive to move, to maintain, to keep, to transfer. So there's a lot of value that can be saved from moving away from that. Increased availability of funding for innovation. So a lot of global investors are taking notice of Africa for the first time. Still, it's very small, minuscule amounts. You see all of the technology industry in South Africa, the venture capital that they raised last year, the whole continent was about $5 billion. When you look at that globally, it's less than 2%. So it's still very early days for these types of investments, and there's still a lot of room to grow. The people who write the biggest checks in the world for investing in business are not yet looking at Africa. And financial services is one of the opportunities that can build a business that can reach the scale that is able to absorb that type of capital. You also see fast growth in spending. So African republics, very new. We're very young as a continent, and many of our workforce are starting to earn money for the first time. So you have a lot of people who are approaching their 30s, 40s, 50s. They've been earning money for the last 10, 20 years. They have money to spend. The Africa of 30 years ago, probably you might not have considered them for a holiday in Dubai or Paris. But now you see many, many more Africans have got more expendable income, and the general wealth is increasing. And with that increase in wealth comes additional needs, and thus people need new ways to be able to spend. The young, fast-growing, urbanizing population, that one I've spoken to extensively. The interesting stat over here is that over 1 billion people in Africa are expected to live in urbanized areas by the year 2045. So you are going to see a lot more demand for financial services over time, and the growth rate only seems to be increasing. Apart from that, the increase of access to internet and lowering of costs of smartphones is really good. If you look at most countries, the cost of data has reduced significantly from the cost it was 5 or 10 years ago. And as more and more people get access to digital devices and to the internet, they start to see the opportunities that those things bring, and thus more demand is stimulated for financial services. So many, many factors are going to help to push this growth. The one thing that I'm very excited about is now the amount of funding which is available for fintech startups. So this chart over here shows the funding for African startups across all industries. So I said, if you look at 2021, you have now over 500 startups that are being funded to the tune of $5.2 billion. That was the amount that was raised last year. I remember when I was still at my last startup in 2016, I made a presentation talking about how amazing it was that the African tech industry managed to raise $367 million. But now that is nothing compared to the 5.2 billion, which was a 45% increase from last year. And so far, it looks like this year is likely to be even higher than last year. I think we've already crossed the $5.2 billion threshold. So aside from the global macroeconomic downturn, I think we still will expect to see an increase in African startups getting funding. And a lot of this funding, I think close to half of it goes to fintech, 45% last year. So it's a very exciting opportunity, and entrepreneurs have access to capital for the first time, and they want to see what they can do with it. So as we wrap up and get into the questions, what really makes a winning startup? If you are assessing, you're writing a story about one, or like some of my friends who have me very excited, you want to start your own thing. Number one is to have a very clear value proposition to your market. And if you look at the successful ones, M-Pesa was to facilitate transfers from the urban areas to the rural areas in Nairobi. And immediately that picked up because there was a need or demand. The danger with the startup industry and the power of storytelling is that we're starting to see people start businesses that are not very viable. And when those businesses fail, it reduces investor confidence in Africa as a whole. It's not that, oh, Wiza's business in Malawi failed. It's that this African startup has failed. And that hurts the rest of the industry's chances in raising the amount of capital that they need to raise in order to get to the scale that they need to get to in order to be profitable. Two is acquiring a large base of active users quickly. I spoke to this earlier, but you can't make money in fintech with 10 users. You need 10,000, you need 10 million, you need 40 million, like Cash App in the United States. When you're at that scale, even if you're charging each user 1 penny for each transaction once a week, you're able to make significant money, enough to cover your fixed expenses because of the scale that you operate. So that one is very clear and simple. Three is having a clear monetization strategy and rolling them out effectively. So the first part, to have a strategy, I think is easy. You can say, okay, I'm going to do loans, I'm going to charge 5%. But to roll it out effectively is where the big challenge is. So we've seen this in the credit industry in Nigeria. Businesses have tried to roll out credit products. They've seen very high default rates. And then they go as far as building systems that take your contacts and start calling your contacts and saying, hey, you know, Wiza hasn't paid back his loan. And then that incentivizes me to pay back, and it starts to work. So it's counterintuitive. The things that you've seen work in other countries might not really work in your country, but it's very important to have clear strategies for how am I going to make my money as soon as possible as I continue to grow. And then because African consumers are not quite yet at the level of spending power as some of their global contemporaries, you have to know that you're not going to be making too much money from each of your customers. So if you look at most of the telcos, they make $1 or $2 from their customers every month. If you look at some of the telcos in the US or Europe, that average revenue per user that they have can go up to as high as $50, $60, $70 per month. So when you know that, okay, I can only make $1 from my customer every month or every 3 months, then you now design your business such that you operate with those realities in mind. Either you go for many, many, many more customers, as most fintechs prefer to do, or you try to monetize your customer aggressively. But that only goes so far because that customer just doesn't have the money to spend yet. Over time, the trend is improving, and we're seeing more and more customers start to have more money to spend. But as of today, it's an economic reality that fintech operators have to be very sensitive to. Number 5, I think it speaks very, very broadly to everything I've covered. Understand and solve for Africa. Yes, it's one continent, but it's not 55 different nation states. There are many cultural differences between these countries. Even the ones that are right next to each other, they share common language, they share common currency, very different way of doing things. So understanding that and building a localized solution for each of the markets that you go to, I think is very, very key. And then number 6, which is very clear from our conversation earlier, if you're not aligned with the regulators, then there's no business at the end of the day. Because the regulator is the one person who can make or break your business. If you have the support of the regulator, as Safaricom did in Kenya, as MTN did in Uganda, it's very easy for you to build a business. If you don't have the support of the regulator, or if the regulator has banned your service or business, then you don't have a business at all. So this is a consideration which many startups leave until it's too late. And I think it's a common mistake I've seen many businesses make. But aligning with the regulator is absolutely crucial to getting up and running and succeeding. When you look at the logos of all of these businesses that I consider winners in the space, you see that they have all managed to follow these guidelines. And I think those 6 factors, they really contribute significantly to the extent to which you're likely to see success or failure. And then, yeah, I think we can do a quick recap and just jump straight to the questions. I think there's 10 of them. And then I wanted to ask some questions so that if someone is able to successfully answer them, I can use a remittance service to send money directly to their wallet. Hopefully we'll see if it works out. Natalie?
Thank you, Wiza. Yeah, I just wanted to run through the questions for you quickly, if that's okay. First one.
Yeah, please go ahead.
From Basiru. So for many players, the level of illiteracy is an obstacle to the development of fintech and financial inclusion in general. What are your thoughts on this?
So I think the telco industry has been able to innovate for this problem very convincingly. Yes, someone can not be literate in terms of words, but many people understand numbers, digits 1 to 9. So if you look at the financial services that exist in Africa, a lot of them are distributed via USSD. This is where you dial maybe *123#. So someone who's illiterate, who doesn't know how to read, they can still understand that, okay, if I dial *123#, I start the menu. If I dial *1234#, I send. If I dial *1235#, I receive. These types of mechanisms are the ones that telcos have been really able to take advantage of. You find that there are many people who can't read well or write, but at least they can use a phone. So I think these are the ways that you can start to think of serving those users who are illiterate. For some other regions where you have enough smartphone penetration, you can actually have text-to-speech apps. So you open the mobile money application and it speaks to you. Then you press a button on the screen to go to the next action and so on and so forth. And with time, as the devices get better, you'll have full voice interaction for mobile money where it speaks to you, you speak back to it, and then the entire interface takes place without you needing to know how to read or write.
The next question is from Martin. He wants to know, how do you know if the financial services offered by fintechs are secure? So he wants to talk about personal data and securing funds, particularly with all the cyber criminals that are out there.
Yeah, that's a very pertinent question. I think it's always up to you to review the terms of service. So every fintech who is credible on their website or in their app or on their menu, they're going to have a terms of service where they speak to you as a customer about how, number one, are they licensed? A good way to know if a fintech is reliable is if it's licensed. Because if it's licensed, it means that it managed to satisfy the regulator who already asked all these questions about how do you secure the system, how do you prevent, how do you secure personal data, and how do you look at cybersecurity. In order for you to get a license from a competent regulator, you need to have answered this question. So the easiest way by far is to check. If you see an advert for a fintech, you often see at the bottom there that there's a partnership. If you look at Wave ad in the newspaper in Senegal, you'll see that it's in partnership with EcoBank and UBA. So those are the licensed parties who are holding the responsibility to secure your funds at the end of the day. If the fintech doesn't have terms of reference, no license, nothing like that, then oftentimes it's a very bad sign, and I wouldn't use that service.
Matilda's question is, you mentioned that mobile money allows access to financial inclusion. So while during transactions, there's a cost to be paid, the same as you would pay a bank, where is the difference with banking transactions?
Absolutely. I think that's a great point. So Traditionally, we've seen mobile money services being expensive and charging on a per transaction basis. But oftentimes, that cost of the transaction, say to send money from A to B, is often cheaper to the customer than the cost of them going to a bank branch, doing a cash deposit, and all of the different steps that they need to do that transaction. I definitely agree with you that the transaction fee model hurts access, and you start to see more and more telcos and fintechs either reduce fees. We saw this a lot all over the world in COVID. So in Uganda, in Kenya, and I think in Ghana as well, as the telcos reduced or outright removed the mobile money charges to enable people to be able to transact more freely. Then you have fintechs like Chipper Cash. We don't charge transaction fees on the sending and receiving of money. We try to find other ways to make money so that we can offer that service for free to further deepen financial inclusion.
Gugu's question is, does the lack of convenient mobile banking services and tech expertise pose a challenge to the growth of the fintech industry in Africa?
I'll say yes and no. Yes, because the fintechs need to be able to build on top of infrastructure, bank infrastructure typically, because of the way the regulation works. So if that infrastructure isn't there, the bank's not offering new APIs. Thankfully, EcoBank has some of the easiest APIs to use in a number of countries. So you can use them for card processing, you can use them for cross-border transfers. If you don't have that infrastructure, it's difficult for you to start to build. But at the same time, the lack of that infrastructure is what speaks to the opportunity. So it's a bit of a mixed bag, and I think it's going to play out differently in different countries. But on the tech expertise side, I think that there's enough new people who are being introduced into the system and learning the technical skills that most technology businesses are not struggling to staff engineering roles yet. But we do see a lot of competition where people move from one fintech to the other or from one bank to the other in some areas specifically.
Ndakate's question, and I hope I've said that correctly, is in West Africa, in the UEMA space specifically, the BCL plays the role of the regulator and publishes half-year reports on the monitoring of electronic money, resources, and services. What about other parts of Africa?
So I'll definitely say that the BCAO is one of the most progressive regulators in the world, in my opinion. Because again, you've got a common currency zone. You've got that opportunity to set standards that many African countries can adopt at once. And what is really great about the BCAO is that if you get the license to do a business, say in Senegal, it's a lot easier for you to go get up and running in Cote d'Ivoire. The approvals are much, much fewer because they use a common regulatory framework. So it's very great. And to the second part, actually, most countries, central banks on their website, they do publish the electronic money volumes every month. So if you go check on the websites of the Central Bank of Kenya, Central Bank of Nigeria, Central Bank of Tanzania, Reserve Bank of Malawi, just to cite a few examples, you're actually able to find that information. The only challenge is that sometimes it can be hidden somewhere on the website, but most regulators actually do. So I'm happy about that as well.
Jarieto's question is very specific to Sierra Leone. And the feedback is that it's hard to achieve consumer protection in the area of technology, financial transactions. And what will happen if this trend seems to continue, specifically in Sierra Leone?
I don't feel qualified to speak to the specifics of Sierra Leone. I've only ever done business in Sierra Leone in telecoms. But I do think that as other countries nearby adopt mature frameworks, it creates examples for the regulators in each country to follow. And the regulators can adopt those frameworks. We've seen it happen already in telecoms. So many countries in telecoms have a converged licensing framework for services like SMS, USSD, etc. But it really started in one country before it was adopted in all of them. So I think with time, that answer will become clearer, but I don't feel qualified to speak to it now.
Perfect. Another question from Gugu. In your opinion, Wiza, where are, and they're speaking as a collective, where are we lacking as African journalists in telling stories about fintech and the transformation of financial services?
I find it difficult to criticize because I don't know what it takes to be a journalist. The same way, if you came to me to criticize me about my financial services progress, I would take that opinion with a pinch of salt. But what I can comment on is what I think is very helpful. You taking the time as journalists to come and learn about an industry, to learn like highly detailed things about an industry, that's a very good sign. Arming yourself with the technical knowledge is a really great step in the right direction. Familiarizing yourself with the local products in your country is also really useful to help to color the context. So those two things I think are a great steps in the right direction. But I personally think that journalists telling stories of African fintech do a great job. I know how hard it is to write. I've written about fintech and I've been published in the World Economic Forum and in Quartz Africa. It's a lot of work. So I think we're doing a good job and we're only getting better.
And I think we have time just for one last question, and it's from Elizabeth. Wiz, I don't know if you can look in the Q&A chat because she has 4 specific questions. So just might be easier.
Okay, sure. So the first one is like, how do the financial activities, I'm not understanding this question well. I'll tackle the second one first. What is the most talked about fintech activities? I think the biggest one is definitely just transfers. It's still very, very hard to move money around in Africa. It's pretty easy in most countries now if you have a bank account within that country. But the moment you want to move money from African country A to African country B, wahala everywhere. So I think transfers are really the main opportunity that many businesses, banks, telcos, fintechs are looking at. With regards to the other question from Elizabeth, does fintech only apply to banking or have more to do with personal finance investment? So we do see fintech apps that are speaking to the investment layer. So for example, you have, in the context of Chipper Cash in Uganda, you can actually buy stocks of shares of companies, both in Uganda, Ugandan public companies, as well as stocks from US foreign companies. So there is the banking side, but then there also is the investment side. And we were the first to initiate that service in Uganda. And we've been able to bring thousands of people who otherwise would not have the opportunity to make investments, to own shares of companies, to be able to own shares in companies for the very first time. So I think fintech speaks to banking, it speaks to investment. And with time, we're going to see more sophisticated credit products. You see today, if you want to rent a house in Nigeria, you pay one year's rent upfront, which is completely crazy. It's the standard. You pay 1 year upfront. But that is so because there's no alternatives for people to get access to their rent on credit. Thankfully, in South Africa, we don't have that. You pay 1 month deposit, then you pay your rent month on month. And then the last question, how do the fintech companies make money? It depends on the service that you're offering. The most common way is usually to charge a fee, so the transaction fee, which is how telco mobile money makes money. Banks and card networks make money from interchange. So when you do a card transaction or you do an ATM withdrawal, they deduct a little bit, typically from the ATM or from the merchant, the person that you're buying from. So say you buy something for 100 francs, the merchant might get 97 francs. And then the 3 francs is shared between the bank and the card network. Because at the end of the day, the merchant needs to be able to accept card payments so that if you go into the shop and you don't have cash on you, you can still be able to pay with your card. Some other ways that fintechs make money is by having a revenue share agreement with the bank who is providing the capital. So for example, if you do a loan application, a loan app service, I can get money, say, from EcoBank and say like, okay, EcoBank, I'm going to charge my customers interest of 7%, and then I'm going to give you 3%, but I keep the 4%. So we share the revenue that is made from the service. Those are the most common ways.
Great. I think we might have 1 or 2 minutes left just for 2 more questions.
Yep.
So Komala's question is, how can fintech contribute to the economic and inclusive development of Africa?
So I think the biggest thing by far is that it enables people to participate in the global economy. Because of the way the world is interconnected today, we are all affected by the global economy, whether we like it or not. So for example, many African countries are seeing increases in food prices because of the war in Ukraine. Ukraine is one of the largest grain producers in the world, and all of our global supply chains are very highly interconnected. So whether you like it or not, you are a participant in the global economy. And fintech enables you to have more of a voice in that economy. By enabling people to access the global financial system, they can make much more informed decisions about their money. They have access to more opportunities. So what that looks like in practice is, if you have a fintech app in Nigeria, you can buy maybe US dollars on crypto and hold your money in US dollars. At the start of the year, the market rate for the US dollar in Nigeria, I think, was around 610 naira to dollar. Today, it's around 745. So there are many users of cryptocurrencies in Nigeria who take their naira and then they buy cryptocurrency stable coins like US dollar, USDC, USDT, which is mapped 1-to-1 with the US dollar. And then they're able to preserve value even as their local currency depreciates. So there's very many specific ways for specific countries that development takes place. But the general theme is that we live in a global economy and we need to be able to participate.
Thank you. The last question before we move to your recap and quiz is, in relation to banks, what positioning should a fintech prefer, or what would their preference be? Would it be a model based on revenue sharing, publisher positioning, or advisory positioning?
I think it's very specific with the relationship with the bank that you're working with. So each bank is going to see the opportunity differently. And you need to align with them to figure out what is the business case which is most compelling for this bank to partner with me. We've seen examples like for the electronic money issuance, telcos will partner with tier 2 or tier 3 banks who do not view them as competitive, right? So they say, okay, fine. You want to build a mobile money service on top of my bank? It's fine, because I don't view you as competitive. Whereas a tier 1 bank that has got its own mobile banking service or digital offering might view that same telco as competitive and not see a business case in that. So it is very specific, but you can always come up with a model that makes sense if you understand what is the bank's priority.
Perfect. Thank you, Wiza. You can proceed to your recap and quiz.
Yeah, so on the quiz, I think I'm going to have to do it asynchronously. I'll send the questions to Eric because I won't be able to access the service that I wanted to use right now. But as a quick recap, I think it will be keen for us to just go over the slides again and then take any last minute burning questions. So again, what is fintech? Simply put, it is just technology used to improve the delivery of financial services. It started with coins. Really, I think, were the first real example of a tangible fintech as per the scientific definition. We had barter trade, which was also fintech, but not very efficient. And then we now moved to currencies, paper money, which was a lot easier for governments to produce. And then that was backed typically by resources such as gold. until the early 70s, where we saw the gold standard disappear for the dollar. And pretty much today, what we have is a state where everyone says that their currency is backed by US dollars, and the US dollars are backed by faith in the US government. And I think as many people start to become aware of this reality, we're seeing people starting to get curious about like, okay, it's not going to happen, hopefully, but what if the dollar collapses tomorrow? How am I going to, preserve my value? In countries like Venezuela and Zimbabwe, where you've seen dramatic hyperinflation due to the collapse of a currency, people have looked to cryptocurrency as an alternative, and Bitcoin specifically. So you see very high rates of Bitcoin adoption in countries like Venezuela and in Zimbabwe. Moving on to the key pieces. There are different pieces of the puzzle. The first and most important one in my mind is always regulation. Then you have the technology infrastructure, which is used to build new experiences, to access a new demographic that other incumbent players might not be able to access. And then you have the support structures, because that technology at the end of the day, you still need to be able to satisfy the global regulation. So you need people to initiate transactions for those things to settle. And then you have the treasury and settlements, managing all of the different buckets of money that you have in different places to give the illusion of instant real-time services as to be consistent with what consumers on the internet are used to today. Can you imagine if you signed up for Netflix and every time you want to watch a movie, it tells you that you have to wait 24 to 48 hours? You wouldn't use it. So it's very, very key that instant nature of transactions is very, very key for the success of fintech. And because the regulation doesn't support that to take place natively on the internet, you still need support structures in order to be able to do that. State of the industry. The main thing, if you're going to remember one thing from everything that I've said, is that 90% of the transactions in Africa are not digital yet. So it's a big, big opportunity. Despite how big the industry seems, there's still a lot of work to be done. And at Chipper and many other startups, banks and telcos, we work very hard every night and day to make sure that we can bring this number as close to zero as possible. It's not going to happen in my lifetime, but we can get close. And the closer we get, we think the more opportunity we can unlock for Africans to start to create their own wealth. And really, that's the major motivator for a lot of us who work in the financial services space, giving people the tools to be at parity as global citizens in this global economic world that we live in. The different types of market architectures, you've got your traditional banking, mobile money, disrupted, and crossroads. Very, very exciting for crossroads markets because there's a lot that you can do there, but then there's also quite a lot of risk. And then the different types of considerations that you have to make when looking at a market. Different countries are at different stages of regulatory maturity, and it's important to know the stage of maturity for the service that you want to try to offer in that country so that you can be able to take the right path and not come up with a surprise when the regulator asks you to shut down. It can be very expensive to recover from a regulatory shutdown. And many businesses that do get shut down by a regulator in financial services never recover because people lose trust in that brand. Key trends, push for financial inclusion. That's happening at a very macro government level all over the world. Removing cash, spoken to about that greatly. The increased availability of funding, it's wonderful. It enables entrepreneurs to take more risk. And the fast growth in spending, Africans are becoming richer over time. The young, fast-growing urbanizing population speaks to the previous point. And then increased digital penetration because of improved access to internet and lower cost of devices. And then COVID, I would say, has positively accelerated digital trends in some countries, but not in all of them. And then lastly, an illustration of how quickly that funding is growing. And yeah, what makes a winner? So I'm very happy to have had this session with you all. You'll receive my quiz asynchronously, and I would like to ask, I'll coordinate with Eric so that you can include your mobile money number. And hopefully if you get the answer right, I'll be able to send you a small token of appreciation using mobile money or a bank account of your choice. Thanks so much for all of the wonderful questions. It's been an engaging conversation. I wish I could have seen you all on the screen, but yeah, back to you, Natalie. I think we're at time.
That's it. Thank you so much, Wiza, for such a great session, and we'll be sure to send your quiz across, and hopefully the lucky person, whoever it is, will hopefully receive your transfer. We hope that you all found the session today valuable, informative, and insightful, of course. I certainly did. Please remember to go to your learning platform where you can access the recordings and the translated materials, and of course the task and the quiz. Please also remember to keep an eye on your emails as there is very important information that is shared before and after these sessions. So until next week, see you all at the same time for a session on artificial intelligence and open banking. Wiza, thank you again for your time and your energy. We appreciate it all. Thank you, everybody. Goodbye.